Welcome to the podcast. I'm Eric Salzman, joined with Richie Bennett and Kevin Doherty. How are we doing, fellas?
What's up?
Nothing.
Not the
Nothing's
market. Not the market.
absolutely nothing.
Rockets and missiles are up and then down, and
Down.
Oh, God.
drones.
Yeah. So what's going on? Give us the take over there, Kevin, in Berlin. Kind of what's happening there, the mood, and just how they're looking at things. Kind of standing.
It's hard to say. I mean, I don't have any deep insight into the what the government is thinking here, but Europe is clearly worried about where things are headed because they're stuck. They need the oil. The energy prices were already very high in Europe, and now they're even higher. Um, the the They've got the Russia on their eastern border who's benefiting from the rise in energy prices. And if the Straits of Hormuz don't open soon, then you have to imagine there's going to be pressure to settle things in Russia and Ukraine so they can open up the energy taps really fully
Hmm.
from Russia. So, but then they're just, the governments here can't get their shit together with their own economies, with their own defense policy, foreign policy. It's just there's no good options from their perspective, and so yeah,
That's not a good place to be.
no, it's not great.
Well, here in the U.S., so this was a pretty, it's continuing to be a pretty brutal week. And I know, Richie, you guys will get into the stocks in a minute, but so when we came into this thing, there was, people were thinking the Fed might go cut one, maybe two cuts, 25 basis point cuts into their policy rate. And the market was really set up for that. And if you remember, right before this all started, the 10-year Treasury note was yielding about 3.97%, and it hadn't been below 4% in quite a while. Mortgage rates were coming down. Things were looking somewhat positive, and that was a positive outlook for certainly for stocks. We'd been talking for a long time about kind of the rotation into kind of the stocks and equities that really kind of the companies that make money, kind of the great rotation trade. And now it's blown up. The Fed now, there's absolutely zero chance that anybody, if you look at Fed fund futures or overnight index swaps, those are the two things that kind of predict it. And there's now zero chance of the Fed cutting. However, there's now about a 16 to 20% chance given that the Fed will actually raise rates in their June meeting in a couple of months.
So, Eric,
Rich-
let me interject.
yeah,
Now, I've noticed though that the guy in the White House has remained. I mean, he's busy, but he's remained very quiet on these rate things lately. Right? No talk of Powell. No talk of Warsh.
yep.
No talk of. Right? So, do you think Bessent is telling him, "Hey, boss, like you can't go out there saying like we need to lower rates. You look like a crazy man." Right? So, like, did you think that's going on? Because he really hasn't said a thing.
Yeah,
I mean, I got to believe he'd go like Nature Boy from the Bugs Bunny cartoons if people really started talking about no, the next move is going to be higher, Doc. It's going to be higher.
yeah. I think that I'm hoping that what they do, I'm hoping Besant is in kind of charge of this thing, from that aspect, and he's kind of like, look, let's just chill. Let's maybe slightly, in fact, it's a great time for him to retreat from that Powell investigation, right? Because no one's paying attention to that right now. So maybe
Yeah.
just pull that back, and but you know, I don't know, and I know Lagarde at the ECB kind of gave the warning that they would certainly adjust policy if they see, the big inflationary shock, which seems to be happening. I don't know what raising rates does when you're having an inflationary shock that has nothing to do with monetary policy. Um, I would fade that move that they're going to raise rates because I can't see it. I can't see it helping. In other words, that's what I'm saying. I mean,
Yeah. And I saw a guy on, I think it was the guy, the macro strategist for Wells Fargo, the head macro strategist. He was on some TV show. And I didn't realize this that the Fed's mandate effectively is to keep prices stable
yeah,
and the unemployment level
Right. The dual mandate.
Right. Whereas the ECB, he said, is no,
Mhm.
it's all price stuff. So it's like they don't care about unemployment, I guess, but they got to keep inflation to a low. So
Yes.
that could lead to crazy, rate rising in the face of like a recession, possibly.
Yeah, and I think that I think Kevin Warsh is kind of subscribes to that this whole dual mandate thing of full employ or relatively full employment and stable prices. And I think that when I say new, I mean I think over the decades that we've kind of shifted into that dual mandate that, like you said, the other big central banks don't have. I think Warsh has been, and I know Besant, when he was writing about, I think he called it a gain of function monetary policy. And he was basically criticizing the whole deal of having an $8.5 trillion balance sheet. And I think Warsh is in that camp too. So yeah, very, very interesting that, but I just can't see that happening without him becoming, I mean, Warsh is going to become a punching bag and, within 6 months, he'll
Right.
start getting, Donald will start taking it out on him.
Right.
But speaking of the Fed, so it was announced yesterday that for 2025, the Fed lost $18 billion, right? I, and they have now lost since they started raising rates, they've lost $245 billion over the last 3 years. And now so here's how they lose that money, because they used to make money when they were cutting rates or rates stayed at zero and they were buying all these assets. They were paying because what they do is they buy mortgage-backed securities or treasuries from Goldman Sachs or JP, and then they credit those guys. That's how they increase the money supply and how they basically did what we're talking about now, where they were actually going for full employment. They were trying to do all these things to get the economy going. So at one point, they had, I think, $8.7 trillion of Freddie Mac, Fannie Mae, Ginnie Mae mortgage-backed securities and treasury notes, bonds, and bills, right? And those were yielding about 2.5% or something like that, probably 2.5. But they were paying on those reserves like 0.25%. So they were making billions every year during this, and they were remitting that money to the Treasury. So that was real money that they were sending to Treasury, which is helping plug deficit holes and things like that. Well, when they lose money, you think, well, what happens? Well, this just shows you how, and you think of these are the guys that are like stable policy, and the real economy and things like that. What they do when they lose money is they basically create an IOU. And it's basically it's called a deferred asset. So they basically owe $245 billion, right? To themselves. There's no counterpart on the other side. And to pay the interest that they're paying on the excess reserves and basically because now they're paying, I mean, think about it. In 2023, they were paying 5.5%, and those assets were yielding 2%, right? So they were getting killed. Now it's kind of because the balance sheets come down a little bit. They are lowering rates a little bit. Now it's let's call it 3.75%. And the coupons on the yield on the gigantic portfolio, which is now about 6.5 billion, I think, that's yielding probably like 3.25%, because they've been putting higher yielding treasuries and stuff in there. So they only lost 18 billion. But can you imagine running a business like that? Like it's all fantasy. You lose money, you just basically electronically create it, and that's how you pay your creditors, the banks in this case. And the plan is that once they start making money again, who knows when or how that happens, they just pay down that IOU to themselves essentially. So can you imagine running a business like that? Can you imagine being a hedge fund because that's essentially what they became. They became a very poorly managed hedge fund.
Oh, it's
Heads I win.
postmodern economics. Everyone has their own truth, and they have their
Heads
own
I
truth.
win. Heads I win. Tails you lose.
But I mean, just think about that. Like these are the guys, right? These are the guys that are, in charge, right? And they're a great economists and they know everything and they basically make sure that inflation doesn't happen while they're creating money to basically pay off this. Again, I don't know how that gets retired. I haven't thought about that too much. But at least they don't have when I first read about this, and I knew because I remember how much money they were making. And then and that went on for a long time. That went on from 2009 all the way up to 2022, pretty much. But I always was wondering what happens when they lose money. And I thought they had to borrow from the treasury to basically pay the difference. But I guess not. Like, as that would be like if they had to do that, people would be so flies on horse shit with these. Like they'd be out. They'd be ridden out on a rail, right? So they've created this fantasy where they just basically pay their bills with an IOU to themselves.
So, question again. Now, they must have some sort of mark-to-market mechanism that tells them every day. They may, right? They may. But when do they announce their loss? Do they do it on a quarterly basis or just at the end of the year? They say, oh, last year we lost X, or this year we made Y. Because
right. There's no like press conference where Jerome stands up there and says, yeah, this is what we did, and here's how we lost money, and here's what we're going to like. Nobody knows. There's probably 10,000 people on the planet who know about this. And that's it, right? No one has any idea that this is what goes on. Yeah, it's
so if they mark to market today, I'm going to guess 2026 they've been losing, especially since February 28th, because that 10-year note has spiked. That's not good for bondholders.
Well, what really wasn't good for bondholders when they had the mortgage backs, they own like when mortgages hit their all-time lows and stayed there, the current coupon on like a Fannie Mae was like 2.5%. And that basically a 3% mortgage went into that 2.5%. That's so all of their stuff, literally when rates shot up and now they're shooting up again, but in 2023, that stuff went from like 100 at par to like 78. Like quickly, right? So when all the you remember the banks started blowing up in 23 also, and then it's like I'm thinking like, God, you're the biggest loser here. Like, like whatever's happening to Silicon Valley, like times it by a million. That's what's going on at the Fed. But there's no market discipline. There's nothing, but that's what happens. That they were a non-economic buyer. They weren't buying based on value. They're buying as part of this policy. And, God help you if you say, you know what, maybe we should rein these guys in. And maybe they should have more accountability, but then you're a MAGA guy if you say something like that.
Or you're a gold bug. And that's, all the gold bugs for all the years, those people are aware, certainly more than the average person, about this type of stuff.
Sure.
Yeah.
Why is gold getting hit? Gold's been getting slammed in this last.
Yeah. I think everybody, I was looking at this. I'm trying to follow this one guy. He seems to be on to something. He talks about, of course he wears his tinfoil hat and he's like, Wall Street always screws the retail guy and he has some good rules. I mean, I won't mention him yet because he's not a sponsor, but he says the amateur hour, which I knew this. I don't know how I knew this, but like the amateur hour in stock trading, it's probably similar to bonds, but there's no, measure really for bonds, but you can tell in the stock market on the tape. But like 9:30 to 10 a.m. is like amateur hour, amateur half hour. Like all the stuff that goes on between 9:30 and 10, none of the big guys are involved. They're just watching, waiting. So there's this chatter now of like manipulation on all kinds of stuff. Like when you're buying, they're selling and vice versa. And he came up with this really good ratio, which was the XLY, which is the ETF for consumer discretionary products, and the XLP, which is consumer staples. So the idea is if people are going out of discretionary, that's the stuff you don't need, but you'd like to have because you have money. If you're going out of that into the defensive stuff, people are getting nervous. So that was happening. That's been happening. And like today, it's really started to happen. So his point was, you don't just like in the bond market, you don't really see what's going on until Wall Street tells you after they've done it, which is
Right.
his theory, which, okay, I get it. I get it. But I think there's some of that stuff going on now. Like that auction, Jesus, that 2 year
Oh,
auction, they said it was
yeah.
the worst. The 2 year Treasury auction the other day was like the worst in decades. Decades.
Hmm.
Tells you like, and at the end of the day, we talk a lot about stocks or whatever, but I'm always with the bond market guys to figure something out first. Like
Right.
the bond market guys always get the sniff, figure it out, and then it trickles into stocks. And I think that's what's going on now.
Yeah, it was the 2 year, 5 year, and 7 year auctions all sucked, and
Yeah.
that's 183 billion. And that's why I you know I I talk about tips, the Treasury inflation protected bonds, and I've been looking at the 10 year, and what I've noticed 10 year tips. So the way you look at the 10 year note, which is yielding about 4.44% right now. And then you look at the tips, which are yielding about 2.11, right? So the difference between that is called the inflation break even, which is about 2.34%. So that's theoretically the expectation of inflation, that break even number that we take the nominally, subtract the tip. That number hasn't moved. Like it literally, you'd think, oh, we're going up in yield because of the inflation, where people worry about inflation. That ain't it. It's just going up. It's called the term premium. To hold that 10 year bond, that 10 year note for 10 years, I want to be paid at least 2.1%. And that has gone up from 188 before the war started to 210. So the reason I'm bringing that up is that because that's one thing in the bond market. People always the dreaded term premium that all of a sudden these it's going to be about people just don't want to hold them, or they want to be compensated more to hold them. So what happens if we really have, which I can't see how we don't, a big inflationary shock that goes on longer than expected? Well, all of a sudden, that break even, if all of a sudden people start pricing in another 20, 25 basis points in the break even number, then all of a sudden you could have the 10 year at 5% before the end of April. And mortgage rates we had that brief little, they were below six. They're at like 6 and 3/8 right now. Probably after today, they'll be like 6.5%.
Just in time for the spring, beautiful spring housing market, right? That's going to
Yes.
like have you seen the home builder stocks? Oh my gosh. Like just all getting whooped.
Yeah.
Like KB Homes, Toll Brothers, like just like nobody is home at those
Right.
things. Like you just can't, and you can't fix it, right? Like
No.
there's no fix. They were Trump did the thing with he didn't want institutional buyers on homes, right? You can't have more than a X amount of homes. But yeah, okay, that's nice, but people still have to live somewhere. Like it's not moving. Obviously, it hasn't moved rates down.
Right.
So that's really what drives it.
Well, it could be worse because last week, again, we talked about this in one of the earlier podcasts. Freddie and Fannie, you remember Trump told Freddie and Fannie to buy $200 billion in mortgage-backed securities. They were in buying heavily. It was reported they were in buying heavily last week. So they're using that as kind of a lever to try to keep a cap on mortgage rates. But it's just a short-term fix. It's like when your currency is getting destroyed and you come in and the central banks or the money, like in Japan, the Ministry of Finance is in buying. Yeah, that screws up guys going at your currency for a while. But if the feeling is that, hey, that currency is going down, it's going to clearly swamp over whatever a central bank can do. And this is it's kind of the same thing. Like you could buy 50 billion tomorrow, and that may bring the yield on Freddies and Fannies down 10 basis points or something. But as soon as you stop, it's heading right back up.
And even with them buying last week or 2 weeks ago, they've
Right.
already lost, right? It's already mortgage rates are still going higher.
Right. And being from Freddie, that's hedging a $300 billion, let's say Freddie and Fannie together now they probably own about 325 billion. That's hard. Hedge, if you're going to hedge that like a hedge fund, the hedges you have to put on and maintain, and I mean, it's a very difficult. And they weren't buying because they liked them, right? They bought because they were told to buy them.
Right.
So, well, I guess we'll deal with that disaster another time but yeah, you're like, I love all these guys. They're like, oh, Freddie and Fannie should be privatized and blah, blah, blah. And as soon as they need them, suddenly they become the non-economic buyer and just another lever to try to, do something short term that'll probably, I mean, they're not going to blow up like they did in '08, but, it certainly isn't good. And again, they're the wards of the government. So if there's a loss, that's a taxpayer issue, I think.
Yep. Crazy.
But it seems like it all comes back to Iran and oil,
Yeah.
right? If the oil prices stay up here, if this isn't resolved, then there's just nothing good comes from that. And we talked about this a couple weeks ago that this thing needs to wrap up within a few weeks, call it a month total, or things are really going to start to get ugly. And here we are. We're 4 weeks minus what, 12 hours from when this all started. So we're a month in. And it's clearly this week people have been worried that the hoped for ceasefire slash resolution slash whatever you want to call it, there seems to be more and more pessimism that this is not going to happen.
Yeah, I think 95% of this move this week is people, walking, buying and selling with their feet and their brains and their money. And it all has to do with a further delay of this thing ending and a further delay of oil prices coming down and a further delay of any chance of ever seeing rates be cut. And that's just what it is.
And anecdotally, amongst my peer group, a lot of people, the conversations, the overwhelming response right now is just go to cash.
Yeah.
And it's interesting that the other day I was looking at some of the previously popular trades were all down. Gold, oil, even stuff that should, in theory, benefit from further chaos in Iran, and then some of the credit names, even the Blackstone, Apollo yesterday, they were up, and it was like, okay, this is interesting. So, the good stuff is going down and the dog shit is floating, and you think about people, maybe they're just literally going to cash, including covering shorts on stuff that they're not thrilled about, but they just want to get into cash and just kind of wait this out a little bit.
Yeah.
There's one good way to make money. If there's a bit of a scandal, right? That when Trump came out, I think it was the first time he came out and jawboned the market, and he made comments that, oh, we're making a lot of progress on these talks. And remember, stocks shot up, and right like 5 minutes before they came out and said this, stocks went through the roof and oil got slammed.
Mm-hmm.
And apparently people have made, I think that they think profits of about $40 to $50 million. So somebody knew what was going to be said before it was said and got in on it. So that's the way to make money. If you got an inside track to the White House, you could probably make a little dough.
Yeah.
Well, Polymarket came out this week and they changed their terms, and they said that people who have firsthand knowledge of events or can impact events, that they're not allowed to trade on those, and so they would turn those over for prosecution. So
does the CFTC, the Commodities Futures Trading Commission, do they regulate Polymark too, or just
Yeah.
They do? Okay.
Yeah.
Well, that's
Polymarket had a problem. For some reason, they couldn't get U.S. They did eventually get it, but you couldn't trade it if you were in the U.S. And now you can.
Right.
But they had some bad news the other day, both of them, in Nevada, because you got to protect your livelihood in Nevada. The judge came out and said no. They put an injunction on both Kalshi and Polymarket. They're appealing it, of course. but saying no sports betting on
Mm,
Kalshi or Polymarket because they're not regulated by the normal procedures as all the other casinos and DraftKings and Flutter and all and FanDuel. They all had to go through a bunch of hoops to get these approvals. Whereas Kalshi and Polymarket just hid behind the CFTC and said, no, we can do this. So they put a little stop to that. We'll see.
yeah.
They're appealing again, but I don't know. We'll see.
Hopefully this
And,
clobbers.
and as an adjunct was the big news yesterday was Meta and Google were found guilty
Yeah.
of the woman who claimed that she was forced into addiction by the Instagram and the social media. So the stuff, I mean, maybe it's just a short-term knee-jerk reaction, but Meta stock got destroyed and is continuing today. Like it's a big deal because there's all these other lawsuits around it that they think, they kept calling it the big tobacco moment. So like, remember back in 20 years ago, right? Big tobacco got found guilty that they caused cancer with their cigarettes. Like nobody knew that, and then they had to pay out huge sums, which they had, and they're still thriving. So maybe that's going to be the case. But I think before the judge's gavel went down, the same lawyers that put the case on to sue Meta and Google said, "Oh yeah, and DraftKings and FanDuel, we got a suit against you because you make people addicted to gambling."
Right.
So it's like a crazy time now. So like because one of their claims was you know when people are losing, right? They're on their website, and then you send them bonuses at night and force them to like, all right, I can get it back.
Right. Sure.
Let's play that.
First one's free.
I don't know what'll happen there, but that can't be good news for a while for them either.
Well, it's good that finally someone is starting to do something about it.
Yeah, I mean, you just can't. I mean, I guess Kalshi and Polymarket just, they knew they had the CFTC, and Don Jr. is on one of their boards, maybe
I think Polymarket.
Yeah, and the old CFTC commissioner is an employee of one of them too, maybe Polymarket as well, Chris D'Ancarlo or something, DeCarlo. So they probably figured, yeah, they're going to sue us, but we got our guys behind us, so we'll be fine.
Right.
We'll see. I don't know, because there has also been the bipartisan bill that's trying to be passed about like when they had they're clear to say that they never said killed, right? But they said, well, the Iranian regime lasts till X. And people obviously made money on that by knowing when we were going to go in and bomb. But they want to have there's like a bipartisan bill going through trying to prevent any of that stuff. But I don't know how you can do that either. I don't know how you regulate that. If you just say the regime is ending, people want to bet on that.
So before we go into making fun of private credit, does anybody have anything positive to say? Usually there's something.
Something. I don't know. I'm trying to. I was looking at a bunch of charts this morning. Man, it's ugly. Like I have this like great spreadsheet that I use technical charts and fundamentals and all that, and it'll line up like when the charts are about to cross to a buy signal and when they're going to cross to a sell signal.
Right.
Good God, it's like It's been a long time since I've seen this many negative vibes. Like it's like 95% of the stocks I was following or ETFs or whatever were negative or turning negative on the charts. And that's usually the bueno.
I was in Ohio this week and I landed in Columbus and I drove to Cincinnati. And first, no offense to the people of Ohio, but there is nothing between Columbus and Cincinnati. That was an hour and a half drive of absolutely nothing, like just flat, no humans. It was anyway. So I had to fill up my tank, on the rental car when I'm coming back, and the premium at a Marathon was I think it was $4. It might have even been 4.10. Not premium. I'm sorry. Just unleaded, 87. And diesel was, I think, 5.79. And I'm just looking at that going, if this keeps up, even at these levels, if unleaded gas keeps up at 4 and diesel goes up to 5, and I have a feeling it's not going down, it's probably going to get worse and go up. This economy can't, I mean, that's when we stop, right? That's when everything stops. I think Richie, you were talking about it about, there goes the vacation. There goes, I mean, like United Airlines came out and said, hey, you know what? Like jet fuel's doubled. For us to secure actual jet fuel right now, it's doubled. And we had a record year last year, and like that's gone like at these levels. So they're going to jack prices up through the roof. But people aren't going to fly. Like this flight that I took to Columbus from DC, I mean, there were like 15 people on the plane. And all I'm thinking is, first I'm like, this is great because I probably have to go back a few times. And then I'm like, this flight will never, they're going to cancel this. This flight's gone, right? I mean, if they're going to fly up, they're not flying any planes with 15 people in them, like that's over with. Especially so, yeah. And I mean, we talked about this last week with, eventually it spills into food prices, it spills into everything. And, this seems like it's worse than COVID, where, you know, COVID, there was at least some solution to the problem, right? That you could do something about it. This is like we broke it, and now these guys aren't going to stop. I mean, why would they? You basically one of the terms of your terms of the deal was that you guys were gone. Like one of the terms of the deal was regime change. I mean, they're not going to do it. And they're watching what's happening over here right now. They're going, we can wait these guys out a lot longer than they can wait us out. Hey,
Yeah.
This is when you hope, the carrot and the stick, that they're not crazy because, they can be bought off, the various mullahs or people in power in Iran. I mean, that's just grasping for straws a little bit here, but, you guarantee those people, hey, your bank account in Dubai, we're going to give you full access to it. And guess what? We just put $100 million in it. If you know, agree to some sort of terms to let this thing end. But that's
They,
just
I did see something out of Israel. Netanyahu said something about how they're focused more now on missile sites than necessarily regime change, which
yeah,
is an interesting point. Like I get it. Like if it's going well, destroying missile sites, and even if the same guys are in power, and if they got no bullets or chances to shoot, maybe they're a little more amenable to listening. But that was a definite. I think that was a definite change in attitude by the Israelis.
yeah. I don't know, Kevin. You brought it up last week. It's at 90 miles of coastline with
1,000 miles.
rockets and
Yeah.
landmines and freaking speedboats, little speedboats that we just can't like. They could like one of the terms that they want is they're like, you pay a toll now when you come through like
Right.
if we settle this whole thing, one of it's going to be you pay us to basically go through, and we need that money because we got to rebuild all the shit that you guys blew up. Um, you know, Trump isn't going to agree to that, and anyway.
Hmm.
On to so private credit, retail private credit funds have just been, and I think they must be somewhat happy about the war right now because every day there's an article about like private retail high net worth retail investors want to get their money out of these private credit funds, and one by one they slam in the redemption gates. And Richie or Kevin, just explain what a redemption gate is.
Yeah, so you have a situation where, I'm sure when they first thought of this idea, there was some good intentions, meaning you're gonna invest money with us. They're good assets. They're off the beaten path assets. They're not traded on an exchange necessarily. We think they're money good. We're putting our own money into this. We're right with you. And the only issue is it's not liquid. And I know every prospectus that comes out about these things states that in like bold letters. Like, so I think they said, listen, instead of trying to sell some of these assets, illiquid assets at fire sale prices, possibly when nothing's going wrong, we don't want you to come in. We don't want you as an investor to come in every week and be like, hey, can I sell this, 10% of my shares for, like I can sell Apple stock where I hit a button and I get my money. No, we don't want that kind of investor. So I'm sure in a lot of these meetings, these retail guys, they understand, right? They get it. So they all agreed, but, what was Reagan's statement? Truth.
Trust but verify?
Yeah, trust but verify. Right. So when these guys, the investors all say, yeah, we got it. We don't ask for our money back. We're good. These guys said, yeah, okay, yeah, you're definitely not going to ask for your money back, or at least a lot of it, because we're going to put up this gate that says we will allow no more than 5% of the entire portfolio to be liquidated every quarter, half year, year, whatever they set up. Yeah. So now you have these rules in place, and people are getting scared. And those same investors that said, yeah, I understand now the whole thing about illiquid, they're all like, give me my money, right? My money. Yeah. And then somebody goes, and a lot of somebody's go, yeah, you see this thing you signed? Yeah, that's 5%. You're not getting your money. You're getting some of it.
And most of the big boys, right? They could slam it down for good, right? Yeah. Now what's interesting is the one we talked about last week, Cliffwater. They were getting like 14% of the fund was redemption requests equaled about 14%. And yeah, they slammed the gates down on the 5, but like I don't think they have. I read that they don't have the ability to slam it down and say, sorry, everybody, you're all you can't take your money out. So a fund like that, I mean, can you imagine 5%, 5%, and then I mean, whatever's going to be left is going to be just complete garbage.
Right.
You got to picture Joe Pesci in the movie Casino meeting with the banker. And the bankers say, hey, you understand this money isn't available right away. I'm like, I think I want it back. And to tell you what I do here when that doesn't happen.
And just when you're waking up from your coma, I'll be getting out of jail. That was great. Yeah. So, what's interesting is, like we talked about last week, banks have lent about just to private credit, not even talking about private equity. They've lent about $300 billion to these funds. That's where they get their leverage. It's modest leverage. It's not crazy leverage until you start losing money, and then it becomes more leverage. But those guys, I mean, think about it. Like they have to be. I mean, Wells Fargo has to be in right now, going through every freaking loan, right? I mean, those guys they have to. And there's all kinds of, I think there's like shorter term loans, like revolving loans that I think I've read that they're pulling back, that basically the liquidity that the funds need, potentially need, they're cutting they're basically limiting their lines as far as getting more exposure to these guys. But what's really interesting was Oaktree. So we read this morning that Oaktree, who has a small, like a $7.7 billion fund, they are honoring redemption requests. They're basically saying, look, if you want your money out, take it. I think they're going to top it up and put more of their capital in. So they're basically saying, like, hey, we're fine. If you want to take your money out, go ahead, and we'll put our own money in. And that's what Blackstone did as well a few weeks ago. So there's. And then the other guys, because last week, I mean, Ares and Apollo, the giants, they both slammed the gates down. And the way they do it is that, well, we're protecting the existing investors from having to fire sale stuff. And I get it, but like, okay, well, if your stuff's so great, show us, give us a sample. Let the public see exactly what it is. And of course, they're not doing that. And I know you guys have feelings about when people do something like that. Like Richie always had that talk about, someone's shorting your stock and it's your company. What do you do? If you
buy it, you buy it with your own dough and push it right in their face. If you got something good,
right? Right.
There's no truer way to hash out what's right and wrong than your own dollar, right?
Right.
So we used to
And
do, just an aside, to find out back in the day when we were on the trading desk, if you didn't know where something was priced, right? And I don't know if kids do it these days anymore. I don't know, but it was a pretty cool thing. So pick an asset, whatever, XYZ corporate bond, and you don't really know. You kind of know where the market is, but you're not sure, but you want to find out. So you want to do a trade. So you would tell somebody, customer or a broker, what have you, if I lock myself, you have to guarantee me a trade, which means if you're locking yourself, you're giving no bid offer on the price of that asset. So you're saying, say you think it's worth 99 and a half ish, and you just say, I'm going to lock myself at 99 and a half, but you must guarantee me a trade, meaning you have to hit me on the bid side or lift me on the offer side. And once that is accomplished, now we all know that was the fairest thing I could have done. Now we all know where the market is, right? And it was a wonderful thing, right? Like it worked, but I think people are still like too scared to do that or whatever. I don't know, but like you can't do that with some illiquid assets, but you can do it with a lot of them. And people would, you'd hit that, you'd say that to somebody for the first time, and they'd be like, "What is that? Never heard of that. What are you talking about? Are you trying to scam me?" Right? And it's like, no, dude,
no.
I'm giving you a price I'm showing you how fair I am, that I'm making no dough on this. I just need discovery on whatever this thing is worth. And this is what I'm doing. Now, do you want to sign up for that? Because I'm not giving you my number until you say yes. But once I give my number, you must lift me or hit me, and we will go on from there.
Meaning buy or sell.
Yes.
When you say lift or hit, yeah.
Yes. Buy or sell.
Well, what's interesting, Richie, and Kevin, is that about a year and a half ago now, God, tell how time is flying. If you remember, I think we may have talked about it on this podcast, or I wrote about it. JP Morgan tried to start a legitimate secondary trading desk, meaning we're going to make markets, and let's make basically let's get price discovery. You could sell them, and now think about it. Like if that trading desk existed, you could point to, hey, oh, fine, stand up to your market, do exactly what Richie said. I'll make a lock market on this, and I don't know if you can make a lock market on that stuff, but the tenor is the same, right? That the private credit guys, they froze it out. They basically killed it. Like nobody would trade on that platform because they knew.
Yeah, sorry, but all that has to happen, right, is JP Morgan does the similar thing. Maybe not block themselves, but oh yeah, your stuff is marked at par in your little fund there, buddy. Yeah, how about 75 my bid, 76 my offer? You think those things are worth 100? You can buy from me at 76. You'll make a fortune, dude. Oh, hello? Are you not there? Oh, okay. Thanks. Click. Right, and that's the whole game.
I miss this. We used to sit there. I miss being on a trading floor and actually listening to Richie do this.
But it's like so fun. Like you back in the day, you'd see this, and you'd see guys try to operate, and obviously it was very different because now it's all done on screens and what have you. It was done a little bit on screens, not the illiquid stuff, but then you'd see, it was a lot on phones, and you'd be like, yeah, what happened there? Like that thing was supposed to be worth like 100. Somebody just traded it at 92. Like, yeah, that was me. Oh, you did? How'd you get them so cheap? I'm like, I don't know if they're cheap at 92. That guy was marketing them at 100. Now I'm the guy, and I got them at 92, and maybe that was wrong.
That's great. So continuing on with private, because I think that, and this is the one I wrote it in Racket last week. I think it came out last week, and it was about the whole insurance angle and the Bermuda Triangle, and just to go over that again briefly, because something happened yesterday in the insurance world that again, it plays on the same theme. And what it is that all the big guys, Apollo, they own Athene, Ares, KKR, Brookfield, all of them play a game where They either own an insurance company and it's a life company and it's offshore reinsurance company. They either own it outright, like Apollo owns Athene, which is I think the largest annuity provider in the world. They own Athene 100%, and they own the reinsurance company in Bermuda, and they manage the assets. Blackstone's a little different. Like some of them, they don't own them, but they manage the assets, and it's still unified. But one way or the other, the common denominator is these guys manage the assets. And what they do is when, Athene goes out and let's say a pension comes in, like a pension risk transfer, Lockheed sends their pension over to Apollo Athene, and now Athene's got those assets. And what they do is there's a liability, right? Because they pay out on these annuities or life policies. And what they do is they cede, CEDE, they'll cede the liability to their captive reinsurance company in Bermuda, which as a friend of the show, Boaz Weinstein, always goes off. You're just basically you're insuring yourself. And they send it over there because there's a lot less regulation, a lot less capital requirements over in Bermuda. And then they have the assets, and guess what they invest in? They invest off of their alternative asset platform, and a lot of it's private credit, private equity, collateralized loan obligations, the riskier parts of these middle market CLOs, and that's what they do. And you've got billions and billions and billions of dollars of life money, insurance, life money, annuities, pension money is all in this stuff. And they call that because generally a pension fund doesn't come and say, I want my money back. And annuity providers generally don't come and say, I'll pay a surrender charge of 10%. I want my money back. So they call that permanent capital. So this is the other world, which is a lot bigger, I think, than the retail world, where they think, hey, we're investing in illiquid assets, and you obviously are not somebody who needs liquidity every once a year or once every quarter. So that's kind of the game, right? And of course, we don't know what the stuff's worth, right? It's the same problems that are happening over in the retail private credit world. It's the same assets. It's got to be. It's the same stuff. It's just in the right vehicle, right? We don't promise liquidity, but obviously a pension fund, if they feel that the manager is screwing up royally, especially if things start getting bad, they can step out. They have the right to basically pull that fund and put it somewhere else. And annuity providers, like we said, there's a surrender charge, but you can get out. Like if the surrender charge is 10%, but you think you might lose 50%, you're going to take your money out. So watching that, and that of course is moving in a lot slower motion, but it's the same thing. So you have to wonder once they starts becoming price discovery, if this thing keeps going, someone's going to be like, hey, are my assets in that stuff? Okay, I want my money back. And you're like Joe Pesci with the banker, right? I want my money back. So the reason I bring it up again is because so there was a huge deal, and it's Corebridge Financial and Equitable Holdings are, I think, for all intents and purposes, merging. These are two huge life companies. They manage pensions. They do all this stuff. Well, guess who manages all of, I think, Corebridge's assets are managed by Blackstone, right? So they're already playing the game. They've got their own reinsurance company. They're already in this game. And you kind of I never really thought about those guys because they're not owned by private equity. I never really saw them, but they don't have to be owned. They just have all their assets, or 90 billion of their assets are being managed by Blackstone. And then Equitable they're going to put themselves together. And I think they're late to the game. I think they're more conservative, but AllianceBernstein manages their dough, a big chunk of it. And Alliance has now gotten into this game as well. So a lot of things, I thought it was limited, a big number, but it was limited to, all right, these 10 companies, but I think they're all doing it. and these guys manage the assets, and it all goes into their alternative asset origination platform, which is all the crap that could be blowing up now.
So I have a life insurance policy with Corebridge. Should I call them up? Should I test the theory now? Hey, yes. What's in my thing? You guys put those over in Bermuda? Like,
Why?
are you guys good? If I croak, can my family get the money or no? Are we not good? And there was also something. Corbridge had something because when I originally got this policy, it was AIG.
Yes.
So AIG must have. Do they still own a piece of Corbridge, or
No,
they
I think no,
shifted
I
a
think it's
bunch of
gone. Yeah.
assets? They sold a bunch of assets to
Mhm.
Corbridge. Yeah, because Corbridge is now which I'm not as thrilled with. I remember when it was AIG, I was a little more pleased. But
Yeah.
it's always important to have your insurance provider to be around when you need the dough.
And this has happened. I mean, insurance companies have failed, or
Yeah.
I mean, where a widow's supposed to get a $2 million payout and she gets $300,000 and doesn't get it for months or years, right? Um, so, and I mean this, and I think once with the pensions, once they move them to Bermuda, I think now you're outside of the pension benefit guarantee, whatever, there's a regulatory body that basically ensures at least a certain amount that, if this pension blows up, we're at least going to pay out 25%. I think you've removed yourself from that as well when you're out. So it's like, and, and again, like we talked about, when the subprime crisis hit, you s- the man on the street saw it, right? You saw your neighbor getting kicked to the curb, or how's Phil, a bartender, owned five rental properties in Florida. I mean, you saw it happening. No one's seeing this. I mean, this is all like the great swindle that's just kind of happening behind the scenes until something happens. And, you know,
Yeah, we'll see.
yeah.
Got to end on something more positive than
Yes.
that.
Yeah.
Uh, there's basketball tonight. We can talk about that.
Let's do
There you
that.
go.
Let's go right to the money-making picks.
Well, there were losing money picks last week. We went 1-2. Unfortunately, the Yukon Huskies won the game, but did not cover the spread because at the tip, which we couldn't relay to you folks here live on a podcast, right before the tip off, pretty much their best player, second best player on Yukon, was scratched. He did not play. So
Mm.
that could have that definitely hindered their performance. They won. And then, of course, he played the next game and they blew whoever out. UCLA, I think.
Was there big action on Polymarket like 2 seconds before the?
I would have liked to check. Because like in the NFL, the only reason in the NFL there's an injury report is for the gambling,
Right.
right? Like you don't care. Like why would you care? Like it comes out on like a Wednesday, right? You're like, oh, so and so didn't practice today. I wonder if that's like yeah, and they list them as probable, questionable, like all that stuff.
Right.
It's the gamblers. They like pour over this thing and like, okay, he's hurt, he's not, he's good, he's not. They don't have that in college yet, anyway.
Yeah.
Yeah. And so yeah, I don't even know. Like I think the guy was in the layup line, beforehand, and I think Coach Hurley just said, "Yeah, you're not moving too good. Sorry, pal." So
Yeah.
that cost us. But we're back on the horse today. St. John's and Duke play. That's a big one for a lot of people. It's tonight, 7:10 Eastern. And I think, both teams are great at defense. St. John's really good at defense, but they have a tendency to go to sleep during the game on the offensive side, meaning they miss a lot of shots. I think it's going to be like a huge bruising game, I think. No free baskets. That's going to be like the message from both coaches. Like if that guy's going to the basket, you hit him. You make him make those free throws, which is usually pretty good because not all these guys are 100% from the foul line. Nobody's 100% from the foul line. So we're going to go with the under in the St. John's Duke game. And then tonight, later, is Iowa State and Tennessee, which is an interesting matchup. Like I don't think a whole lot of people had that one in their brackets beforehand, but it is what it is. And the same thing, I think that a lot of these teams that have made it this far definitely have a defense and they have good guard play, which means the guards distribute the ball well, don't make a lot of turnovers. But again, they have to earn their hoops, earn their baskets to make it. So we're going to go under again, Iowa State, Tennessee. And then in the late game as well, there's 4 games. 2 are 7-ish Eastern time, and 2 are 9:30-ish Eastern time. Michigan and Alabama, which is an interesting game. Michigan is doing very
Probably be a better football game.
exactly. These are football schools, right? But somebody's going to the round of 8 after tonight. The point spread is like 9.5 or 10. Bama's getting like 9.5 or 10. They've been playing great. They had a slight problem before the tournament where their second best guy opened his dorm room door, and on the table was about 3 pounds of pot. So he's not playing right now. He may be playing for the prison team, but
to distribute.
he's not playing on the NCAA game.
He was distributing. Is he a guard?
No, he was a forward, but
Okay.
they haven't seemed to miss a beat. They won both of their games handily. Michigan's great. They're like definitely one of the favorites to win it, but I could see that game being close. That's a lot of points, 10. So we're going with under St. John's and Duke, under Iowa State, Tennessee, and Bama plus 10 or whatever you can get, 9.5, 9.
So you're taking Cool Hand Luke
There we
in
go.
that one.
There we go.
All right. Well, we ended on, I think, a happy note.
Well, we'll be happy if they win. But
Yeah. Well, let's hope when we talk next week that things are better.
everything
Right?
is better. Yeah.
It's positive attitude. Say your mantras, whatever you got to do, because this is terrible. All right. See you guys.
All right.
See you next week.
Take care.